Risk and return are two of the most important concepts in finance and investing. Essentially, the more risk you take on in an investment, the higher the potential return. Conversely, lower risk investments tend to have lower potential returns. It is important to understand this relationship when making investment decisions, as it will help you choose investments that align with your financial goals and risk tolerance. Additionally, it is important to understand that past performance is not indicative of future results and that no investment is without risk. To manage risk in investing, diversification is key. This means spreading your investments across a variety of asset classes and not putting all your eggs in one basket. Additionally, working with a financial advisor or professional can help you make informed investment decisions and choose investments that are appropriate for your individual financial situation. Inflation is an economic phenomenon that occurs when the general price level of goods and services increases over time, resulting in a decline in the purchasing power of money. In other words, inflation means that the same amount of money can buy fewer goods and services over time. Inflation affects the value of your savings and investments by reducing the buying power of your money. This means that, if the rate of inflation is higher than the interest rate on your savings account, the real value of your savings will decrease over time. Investing in inflation-protected securities, such as Treasury inflation-protected securities, TIPS, can help protect your purchasing power against inflation. Additionally, investing in stocks and other growth-oriented investments can also help offset the effects of inflation, as the potential for capital gains can help preserve the purchasing power of your money. It is important to understand the impact of inflation on your finances and to consider it when making investment decisions. Diversification is a risk management strategy that involves spreading your investments across a variety of asset classes, industries, and geographical regions. This helps to reduce the impact of potential losses in any one particular investment, as poor performance in one area may be offset by strong performance in another. Diversification also helps to spread risk and ensure that a significant portion of your portfolio is not heavily invested in one particular asset class or sector. There are several types of diversification that investors can use to spread their risk, including asset class diversification, sector diversification, and geographical diversification. Asset class diversification involves investing in a range of different asset classes, such as stocks, bonds, and real estate. Sector diversification involves spreading your investments across different industries, such as technology, finance, and healthcare. Geographical diversification involves investing in different countries and regions, which helps to mitigate the risk associated with any one particular economy or geopolitical event. Ultimately, diversification is an important aspect of investing and risk management, as it helps to reduce the impact of potential losses and increase the likelihood of long-term success. By spreading your investments across a variety of asset classes, industries, and regions, you can better manage risk and increase the chances of reaching your financial goals. Retirement planning refers to the process of preparing for a financially secure retirement. This involves evaluating your current financial situation, determining your future financial needs, and taking steps to meet those needs through various retirement savings options. One important aspect of retirement planning is calculating how much money you will need to retire comfortably. This calculation takes into account various factors such as expected expenses, inflation, and life expectancy, and is used to determine how much you should be saving each year to reach your retirement goals. There are several retirement savings options available, including employer-sponsored retirement plans, such as 401(k)s and pensions, individual retirement accounts, IRAs, and annuities. It's important to understand the pros and cons of each option, and to choose the one that best fits your individual needs and financial situation. Retirement planning is a long-term process and should start as early as possible to allow for maximum savings and investment growth. Regularly reviewing and adjusting your retirement plan as needed will help ensure that you are on track to reach your retirement goals. Estate planning is the process of arranging for the distribution of a person's assets after death. This process typically involves creating a will, which outlines the individual's wishes regarding the distribution of their assets and the appointment of a guardian for any minor children. Estate planning can also involve the use of trusts, powers of attorney, and other legal instruments to manage the distribution of assets and ensure that the individual's wishes are carried out. One of the key benefits of estate planning is that it gives individuals control over how their assets will be distributed after death. This can help to avoid disputes among family members and ensure that assets are distributed in a way that is consistent with the individual's wishes. Estate planning can also help to minimize taxes and other costs associated with the distribution of assets, and ensure that the individual's assets are protected in case of incapacity or other unforeseen circumstances. It is important to seek the advice of a qualified estate planning attorney or financial advisor when creating an estate plan, as there can be complex legal and tax implications associated with the distribution of assets. Regularly reviewing and updating your estate plan as needed is also important to ensure that it remains consistent with your wishes and is updated to reflect any changes in your financial situation or personal circumstances. Taxation is a crucial aspect of estate planning and financial decision-making. It is important to understand the tax implications of different financial choices in order to make informed decisions and maximize your wealth. Tax laws and regulations can be complex and can change over time, so it is important to seek the advice of a qualified tax professional when making financial decisions that may have tax consequences. For example, in estate planning, it is important to understand the tax implications of creating a will or setting up a trust, as well as the potential tax benefits of gifting assets or leaving assets to certain beneficiaries. In addition, there may be tax implications for financial decisions related to investments, retirement planning, and wealth management. In general, it is wise to consider the tax implications of any financial decision you make, in order to minimize your tax liability and maximize your wealth. By working with a qualified tax professional, you can make informed decisions and take advantage of tax-saving strategies, while ensuring that you are in compliance with all relevant tax laws and regulations.